Thank you very much. And thanks for this excellent opportunity to present my JOMAC paper, that's Decentralized Finance or DeFi Democratize Access to Financial Services. My understanding of democratization of finance is to make financial services broadly available. So this aligns with the core mission of DeFi. To be more specific, DeFi aims to facilitate financial inclusion, equality, and democratization. So this paper aims to test DeFi's effectiveness in achieving these goals by looking at one of the largest DeFi applications named decentralized financial lending or DeFi lending. Let me briefly talk about what DeFi lending is, and then I will go back to the motivation. The DeFi lending, it automates borrowing and lending on the blockchain without the need for centralized intermediaries. If we think of this bank lending model, for banks in the United States, depositors, they make deposits in the US dollar, and in return, they earn interest in US dollar. From the borrowing side, borrowers, they could provide documentation to verify their creditworthiness, or they could provide collateral to secure their loan positions. For example, for real estate-based borrowing, borrowers use real estate properties as collateral, Ripple transactions, investors use treasuries as collateral. For example, the margin trading, borrowers, they use securities as collateral. So after banks conduct this credit risk analysis, banks issue loans in the US dollar, and borrowers will need to pay interest. So the overall operation of banks would be closely monitored and governed by the US government. So I will walk you through step by step how DeFi lending differs from bank lending. So first of all, DeFi lending, it operates as a global market. It can be deployed anywhere. Anyone with an internet connection can participate on DeFi lending platforms. It heavily relies on collateral at current stage. Depositors make deposits in cryptocurrencies, and in return, they earn interest in cryptocurrencies. DeFi lending platforms do not conduct credit risk analysis. The only thing they need is collateral. The accepted collateral nowadays would be in the form of cryptocurrencies, and recently several DeFi lending platforms have started to accept tokenized treasury as collateral. After borrowers provide sufficient collateral, they could borrow from DeFi lending platforms, and they would pay interest. The one thing I would like to point out here, borrowers, they face the same collateral requirements and pay the same interest rates. Regarding the governance, DeFi lending platforms are governed by governance token holders. So governance token, you can think of them as the equity shares issued by firms. So for those, they are shareholders. So for those governance token holders, they could be developers or founders of the DeFi lending platform, or they could be investors who hold positive sentiment regarding the platform. So overall, this figure shows you the structure of a typical DeFi lending platform. Let me go back to the motivation of this paper. So as argued, DeFi has this potential to make financial services broadly available. It reduces the reliance on centralized intermediaries. It can be deployed anywhere. Anyone with an internet connection can participate. To be more specific, it provides access where jurisdictional barriers are present. For example, it grants investors access to markets that are otherwise inaccessible or costly to entry. One more thing here, the DeFi lending platform, they do not require extensive documentation such as credit scores or proof of income. However, in the literature, it documents that DeFi at current stage faces challenges in incorporating information. In this model, you can see currently DeFi lending platforms requires loans to be over collateralized, and the accepted collateral, the majority of the accepted collateral is in the form of cryptocurrency, but the prices of cryptocurrencies are highly volatile. So it is easy to imagine borrowers without sufficient cryptocurrency holdings, they could be excluded. They would not choose DeFi lending platforms to borrow liquidity. Overall, it is far from clear empirically whether DeFi is facilitating financial inclusion, equality, and democratization is an economic reality, which makes the evaluation of DeFi's effectiveness in achieving these goals a first order question. So, this paper aims to test this DeFi's effectiveness. And to be more specific, this paper aims to quantify the borrowing constraints in DeFi lending markets. Okay, so let me explain more about this market. So the DeFi lending sector started in 2018, and nowadays the whole sector has around 57 billion in total deposits and has around 20 billion in outstanding loans. Borrowers, they either borrow stable coins or seek investment opportunities within the DeFi sector. DeFi lending, they operate lending pools. Each lending pool facilitates borrowing and lending for one type of cryptocurrency. For example, the USDC pool here collects deposits in USDC and issue loans in USDC. To borrow from the lending platform, borrowers would need to provide collateral. The amount of collateral they will need to provide is regulated by a parameter named liquidation threshold. So let's say the liquidation threshold is 80%. It means that with $100 of cryptocurrency collateral, borrowers, they can borrow up to $80. If they borrow more than $80, their positions would be liquidated. Equivalently, it means that to borrow $80 in cryptocurrencies, borrowers need to provide $100 or more than $100 of cryptocurrency collateral. So let me walk you through an example. Let's say Alice is a borrower. She wants to borrow USDC, $80 USDC, and she has Bitcoin holdings, and she wants to use Bitcoin as collateral. Currently, the liquidation threshold for Bitcoin is 80%. It means that Alice will need to provide $100 or more than $100 of Bitcoin. So let's say Alice provides $100 of Bitcoin. Her position would be safe because this loan to collateral value ratio is equal to this liquidation threshold, 80%. At the end, Alice account shows an $80 loan in USDC and shows a $100 deposit in Bitcoin. Platforms can adjust these collateral requirements by increasing or decreasing this liquidation threshold parameter. So let's say platforms want to relax the collateral requirements by increasing the liquidation threshold from 80% to 85%. It means that for $100 of Bitcoin now, Alice can borrow up to 85. So if Alice borrows an additional $5, her position will still be safe because her loan to collateral value ratio is equal to this new liquidation threshold parameter, which is at 85%. Okay, so after we talk about the operation of DeFi lending, let me show you the main results of this paper. I investigate borrower behavior on the two largest DeFi lending platforms named Aave and Compound. On average, the data shows that borrower supply 536,000 cryptocurrencies, and they would borrow around $211,000. They do not fully utilize their borrowing capacity. on average, platforms allow them to borrow $80 for every $100 of collateral, but the data shows that borrowers they would only borrow $44 for every $100 of collateral. So that is around 50% of their borrowing capacity, which suggests that borrowers could be constrained by collateral requirements and they would prefer a significant buffer to prevent their positions from liquidation. However, an alternative story could be those borrowers, they have secured the amount of the loan they require and they do not need to borrow more in this market. So I utilize events where platforms relax those collateral requirements to better understand why borrowers borrow less than they could. So let's say before the relaxation, platforms allow borrowers to borrow $80, but after the relaxation, platforms allow borrowers to borrow $90. So they can borrow an additional $10 and they will not face liquidation. If borrowers borrow more after the relaxation events, it suggests that before the relaxation, they are constrained by the collateral requirements. And if they do not borrow more after the relaxation, it suggests that they do not need to borrow more in this market, and they are satisfied with the amount they have borrowed. From the data I observe, borrowers, the economic magnitude is this. On average, let's say the platforms allow borrowers to borrow an additional So at the end of the paper, I test not access the lending market. It is difficult to imagine any market could provide this equal access. This is one of the goals of DeFi lending. To achieve this DeFi lending, the borrowers in this market they face the same collateral requirements and they would pay the same borrowing cost. If DeFi lending provide this equal access, they are constrained. They are equally constrained by the collateral requirements. However, the collateral requirements are more likely to constrain borrowers without sufficient collateral. So I use the leverage ratio. You can think of it as the asset to equity ratio. I use the leverage ratio to measure the amount of collateral borrowers provide on the platform. Leverage the borrowers, they provide relatively low amount of collateral on the platform, and low leveraged borrowers, I observed that highly leveraged borrowers, they borrow more and raise leverage further. It suggests that before the relaxation, highly leveraged borrowers, they are constrained by the collateral requirements. However, for borrowers with low leverage, they would not respond to the relaxation events, which suggests that borrowers who hold sufficient collateral. Okay. So in today's presentation,
Sorry.
I will first talk about the empirical design. Yes, sure.
Yes. Can I ask a couple of clarified questions before you go into empirical? When
Sure.
borrowers are underutilize their borrowing capacity, do they earn some interest on the
Mhm.
over-collateralized deposits?
Uh, Deposit positions, borrowers can earn interest. So no matter they over collateralized or under collateralized, the deposit positions they could earn interest.
I see. I see. And do we have any understanding of where the money goes to? Like, what's the what's the purpose of the borrowing? And would that change any of these results that you're looking at?
I see. This is on my to-do list. In the next step, I would link several platforms with this lending firms. I would like to show the purpose of borrowing. But as documented in the literature, the DeFi land literature, it suggests that borrowers they would either borrow stable coins or they would like to engage in the liquidity programs issued by those DeFi platforms. But that's a very good point. I would link several platforms with this lending platform and to show where the flow of the money.
And
Yeah,
just double
thank you
checking,
very much.
for example, for Aave, um, for example, you deposit $100 of, let's say, worth of ETH, and then you are earning some interest on that, and then you can borrow, let's say, for USDC for the borrowing interest for USDC.
Yes, yes. You earn interest if you supply cryptocurrencies, and you pay interest if you borrow against the collateral.
No, no, no. Yeah, yeah, exactly. What I'm saying is that but you don't earn interest on the collateral itself, right?
You earn interest on the collateral too.
I
So
see. But wouldn't
if
there be
you,
a gap like
yeah,
for on Aave, I think USDC it's like what, 10% right now?
yes, yes,
And
yes. The USDC is around, yeah, that's right. There is a gap. So if you are talking about the net interest rate,
right.
so borrowing side interest rate minus the depositing interest rate, there's a gap. You will need to pay. Yeah. So
I see. Got it.
I
Okay.
still, yeah.
Um,
Okay.
can you hear me? So
Yes, sure.
sorry, first my internet connection it's not so good. So I don't know, Kite, for you everything works smoothly?
I think it might be Chang's internet connection is a little bit cutting in and off.
Okay.
I think it's not
Ah,
you.
Yeah, it's not a big deal,
Because
but
I
it's
always experience it. Yeah, it's I
yeah,
think there's like a half-second lag or something.
nice. So I let me jump on something that Kite said and maybe let me rephrase it as I see it. So maybe it's not in terms of DeFi lending provide equal access to financial service, because I feel in a technical aspect, a big borrower and a small borrower, both of them can um, kind of proportionally lend the same amount of money. So they have the same access for financial service. It's more a question about what are the opportunities for them to use this financial service in terms of like maybe big lenders, like maybe big borrowers have more. That's why I think I'd say what they use it for. They have more
yeah.
opportunities to use it, so they can even pay higher interest rate because they have much more gaining opportunities than the small traders. So maybe there is some financial uh, like yeah, it's interesting to see which opportunities big traders have that
I
small
see.
traders has.
Yeah.
Not in terms of getting the money, it's more about where they can invest it, right?
Yeah.
And
I see. So that's a very good point. That is I definitely would like to explore in that direction. So here I could again, I think there's a way to link several platforms together, and I could show the different opportunity set, investment opportunity faced by
exactly.
different types of borrowers, and it would it, this is a very good suggestion. I could rather than just talk about the collateral requirements shocks. I could talk about the type of investment opportunities faced by different borrowers. Yeah.
Exactly. This will be a kind of very interesting to see.
Very interesting. Yeah, thank you very much. Thanks so much. All right. So let me go to the empirical design of this study. I utilize the events where platforms relax the collateral requirements to test whether or not borrowers are constrained by the collateral requirements. So there are several problems in this design. First of all, shocks to collateral assets could lead to adjustments in collateral requirements and influence borrower behavior simultaneously. To address this concern, I compare borrowers using the same type of collateral asset but subject to different collateral requirements. So let's say there are two borrowers named Alice and Carol. Both of them want to use Bitcoin as collateral to borrow liquidity from lending platforms. Alice supplies Bitcoin to one of the platform named Aave, and Aave has this liquidation threshold for at 80% for users using Bitcoin as collateral. Carol supplies Bitcoin to another platform named Compound, and Compound has the same liquidation threshold at 80%. But later on, Aave relaxes the collateral requirements by increasing this liquidation threshold from 80% to 85%, but Compound does not change the collateral requirements. So I compare Alice with Carol. In this way, I can control for any collateral level shocks because collateral level shocks are invariant to borrowers such as the Bitcoin volatility, Bitcoin returns. Those are invariant to borrowers in the treated and control group. The second challenge could be the reverse causality. For example, I would like to see how relaxation in collateral requirements affects the borrowing decision. But what if this increased borrowing behavior incentivizes platforms to relax the collateral requirements? So to address this concern, I test borrower responses at 3 stages of proposal. To relax the collateral requirements, platforms will need to first create a proposal, and this proposal will enter 2 to 9 days discussion stage. During this stage, all of the market participants can share their opinions regarding this proposal on a public forum. And after the discussion stage, the platform will enter a voting stage. There are a few days, 2 to 4 days of voting stage. During this time, the governance token holders they vote on the proposal. At the end of the voting stage, if the proposal receives a majority of affirmative votes and achieved a predetermined quorum, this proposal would be successful. And if this proposal does not meet those requirements, this proposal would be rejected by the platform. And for the successful proposal, it will enter a time lock period. The time lock period lasts 1 to 3 days. During this time, the platform would do final reviews and preparations, and then the platforms officially execute the proposal. So I divide a sample period into 3 stages. Let's say before the discussion stage, the liquidation threshold is at 80%. And from discussion to execution stage, during this stage, the platforms are still discussing this proposal and voting on this proposal. The liquidation threshold remains at 80%. And after the execution, the liquidation threshold increased to 85%. So let's say the increased borrowing demand incentivizes platforms to relax the collateral requirements. Such kind of factors would take effect starting from this discussion stage. So if I observe borrowers increase borrowing starting from this discussion stage, it suggests that the borrowing behavior is not driven by the change in collateral requirements because currently during this stage, the liquidation threshold still remain at 80%. So overall, this is my empirical design, which helps to mitigate the endogeneity problems in this study. Okay, the data set, I hand
Can I ask a
collected.
question?
Sure, of
So
course.
the change was only in the specific pool, or it was in all others pools?
There are from the proposal observed, there's several pools will change the collateral requirements together, but
So
not all of the pools. The several pools they would change collateral requirements together.
I see. So if you go back,
Yeah,
so when you do the control with the other lending protocol, it's compound, right?
yeah, compound.
Yeah. I see. So question, because as I see it, there is few aspects that like in order to make like really good apple to apple comparison. So it's also good to have a control that you kind of control in the sense that it's the same tokens, same like trading pair, but the difference is between changing the requirements and things, but it's different protocols which can attract different traders. So the question is if you also can have another control that you check with different tokens but the same protocol. So
I
for
see.
example, if you check in Ava same token, different tokens that didn't change the collateral requirements, it also can be another different diff
Yeah,
to
yeah,
control.
yeah.
Because I'm not really sure, but I think that there is some little different aspects between the protocols. Also, there is a community aspect that is different between them.
You are right. You are right. Yeah, I will show you more details regarding the why platforms would like to change the collateral requirements, but your points are valid. It's different protocols, there are different communities, and there could be some the characteristics we are not able to see drive the collateral requirements and drive the borrowing behavior, and it's that is but also a very good suggestion. I could look at users hold different tokens but on the same platform and to do the robustness check.
Yeah, I feel like it's just going to give you more confidence, and I think it should be the same direction, maybe.
Sure.
Yeah.
Yeah. Thank you very much.
Sure.
Okay. Let me show you the data set. I obtained the pool level and account level data set from the Missouri database. At the pool level, this database gives the interest rates, the amount of deposits in the pool, and the amount of liquidity borrowed from the pool. At the account level, this data set gives me the loan and deposits amount for each account. So I define borrowers as accounts with open borrowing positions at the timestamp of proposal creation. So before the relaxation events, if borrowers have already have this open borrowing positions, I define those accounts as borrowers. And I obtain daily crypto prices from CoinMarketCap. At the end, I construct weekly balances during a 7-week window around execution. The sample includes around 466,000 borrower week observations across 14,000 borrowers. So this figure shows you the evolution of DeFi lending sector. The y-axis is the total deposit amount in the US dollar, and the x-axis is from January 2020 2019 to January 2023. DeFi lending sector started in 2018. Before 2021, the total deposit amount is lower than 1 billion. And from 2021 to 2022, the whole sector experienced significant growth. The deposit amount reached to peaks of over 70 billion. Here, the total deposit amount dropped to around 20 billion after the collapse of TerraCoin. And nowadays, the deposit amount rises again, and currently the total deposit amount is around 57 billion. So my sample period is from January 2020 to December 2022. You can see during this period, Aave version 2 and the compound version 2 dominated the market, accounts for over 50% of the total deposits. Similar pattern here for total loan amount in the US dollar. A few statistics I would like to point out. In 2022, the loan amounts reached to peaks of over 25 billion and dropped to around 5 billion after the collapse of TerraCoin. So what type of cryptocurrencies users like to supply? This figure shows that USDC, DAI, Bitcoin, the wrapped Bitcoin, wrapped Ethereum, those are the most popular currencies users would like to supply. Those pools account for over 90% of the total deposit around the sample period. So what type of cryptocurrencies borrowers would like to borrow? Stable coins. USDC and DAI, those stable coins are the most popular one. Borrowers, those pools accounts for over 80% or 90% total loans on the platform. So if we look at the borrowing cost, this figure shows you the borrowing rate from January 2021 to 2023. Borrowing rates could be highly volatile. For example, before the 2022, the borrowing rates occasionally exceeded over 30%. So this is annualized borrowing rate. And it remains stable after 2022. The green dashed line shows you the secured overnight financing rate. So this is a benchmark for borrowing cash overnight collateralized by treasuries. So you can see the DeFi lending borrowing costs it was even lower than the SOFR rate after Federal Reserve raised the federal funds rate. So similar pattern here for the lending rate. The lending rate occasionally exceeded over 15% and remained lower than 5% in 2022. So there are 8 proposals in my sample. The first proposal was initiated by Compound. Compound would like to relax the collateral requirements for users using USDC as collateral. To do that, they increased the liquidation threshold from 75% to 80%. This proposal was first discussed on October 25th in 2021, and after 2 weeks of discussion and voting stage, the proposal was officially executed on November 9th in 2021. The last proposal in my sample was initiated by Aave. Aave would like to relax the collateral requirements for users using Bitcoin as collateral. They increased the liquidation threshold from 80% to 82%. This proposal was first discussed on October 7th in 2022 and was officially executed on October 15th in 2022. So those proposals are all proposed by a DeFi research firm. I will show you the methodology they use in the next slides. But I would like to point out for each proposal, the number of voters ranged from 4 to 357. The majority, they obtained the majority of affirmative votes. on February 14th in 2022, they published their parameter recommendation methodology. In this post, they say our goal is to balance this capital efficiency and risk to the protocol. What does it mean? So at the high level, they say they would solve an optimization problem where the objective is to minimize the expected insolvent debt and liquidation, but maximize the borrow usage. So my understanding is that they would automate this parameter selection process by minimizing this amount of debt that exceeds the value of collateral, minimize the liquidation events, but also maximize the amount of capital that is being borrowed. So this is how they choose the optimal collateral requirements for those DeFi lending protocols. Okay, summary statistics. On average, users they supply 536,000 cryptocurrencies. The median is lower, way lower. It's around 26,000. Borrowers they would borrow around $211,000, and the median is around $9,000. The leverage ratio, I define it as the asset to equity ratio, the total borrow plus total deposit divided by total deposit. The leverage ratio is around 1.44. It means that for every $100 of collateral, borrowers will borrow around $44. So this shows you an example of a distribution of leverage ratio. Let's say here, for those borrowers, they are not, they are, so I exclude under collateralized positions. Those borrowers, they all have, currently they have safe positions. Let's say the liquidation threshold here is 1.8, and borrowers, they would stay at around 1.4. So it means that they would only borrow 50% of their borrowing capacity. So let me show you the first results. Yes.
Sorry, maybe I'm confusing myself. So suppose your collateral is $100 USDC, and you're borrowing, let's say you're borrowing DAI. Okay. What this means is that for every $100 of USDC you deposit, you borrow out $40 DAI.
Yeah.
Okay. And do I pay interest for the $40 that I borrow, or the full $80 that I'm allowed to borrow?
$40 you borrowed. So
And
you only yes.
And I earn interest of the 100 USDC I deposit.
Correct.
Is it possible that I earn money when I borrow? If you imagine if I just deposit and borrow nothing, I'll be just basically deposit my USDC and earn interest. So that's the same as not borrowing, but just depositing, right? So that will be the people on the very left-hand side, right? The leverage is 1. The leverage ratio is 1. Would you consider them as just deposits, as lenders, or they're still borrowers? Like how do you like cut off there?
I see your points. So so please correct me if I'm wrong. So the points you make is the leverage ratio may divide lenders and borrowers in this market. Even though the leverage ratio here 1.2, they have this open borrowing positions, but they could be the lenders because they would like to have this positive. They would like to earn interest instead of pay interest. So they would have a relatively small borrowing positions, and this would be a problem in my design because they are technically not borrowers in this market, and I think it could be. I think it's but I will think more on it. I am not sure how to address this concern, but I think it's a very interesting and it's a fair point. The leverage ratio, although they show the to some extent they show the amount of collateral they provide on the platform, but it could also divide users into different categories. I will think more on it, but I don't have a good answer right now. Sorry for that.
Okay.
Yes. Okay. Um, all right, so let me show you the first results are borrowers constrained by collateral requirements. I utilize events where platforms relax those collateral requirements. If borrowers, they increase borrowing following the relaxation, it suggests that they are constrained by collateral requirements before the relaxation. But on the other hand, if borrowers do not respond to the relaxation events, it suggests that they have secured the amount of the loan they require and they do not need to borrow more. So I utilize the following regression. The y variable is the loan amount. This regression tests the percentage change of the loan positions. Beta 1 here, treated by discussion to execution. Beta 1 captures the percentage change in loan balances when platforms are still discussing the proposal and voting on the proposal. Beta 2 here captures the percentage change in loan balances when platforms officially execute the proposal. This table shows that after the relaxation events, the borrowers would increase loan balances by 9.2%. The second column include the collateral by week fixed effects, and the results are similar. The third column includes this treated by discussion to execution variable. So this variable tests the percentage change in loan balances when platforms are still discussing and voting on the proposal, and it shows that borrowers would not increase borrowing when the collateral requirements have not changed. So the increased borrowing behavior, it suggests that the increased borrowing behavior are driven by the change in the collateral requirements. And this figure shows you the dynamics of loan balances. You can see before the relaxation events, the loan positions, the loan position for the treated borrowers are not significantly different from loan positions for the control borrowers. And after the relaxation, the treated borrowers increase borrowing. Okay, so I will think more on the test regarding the equal access, but let me show you what I have now. Does DeFi lending provide equal access? Borrowers, they face the same collateral requirements, they face the same borrowing costs. If the DeFi lending platform provides equal access, borrowers, they would increase borrowing independent of their other characteristics. However, on the other hand, if the over-collateralization design is more likely to exclude borrowers without sufficient collateral, and I use the leverage ratio to measure the amount of collateral they provide on the platform, the highly leveraged borrowers, they pledge low collateral relative to their loan positions, and they're more likely to increase borrowing. And I sort borrowers into quartiles based on the leverage ratio before the proposal discussion, and I examine borrower responses across quartiles. So if we go back to this figure distribution of leverage ratio, the red line, yellow line, and black line shows you the 25 percentile, 50 percentile, and 75 percentile. So users in quartile 1, and users in quartile 2 here, and users in quartile 3 and quartile 4. Then this figure shows you the percentage change in loan balances across 4 quartiles after the platform relaxes the collateral requirements. You can see the borrowers with low leverage, they would not respond to the relaxation events. And for borrowers with high leverage, they would significantly increase borrowing after the relaxation events. Okay, so the following figures shows you the leverage dynamics. Again, borrowers with low leverage, they would not raise leverage further after the relaxation. However, for borrowers with high leverage, they would significantly increase their leverage ratio after the relaxation events. Okay, so to test the significance level, I used this triple difference. I interacted the treated by discussion to execution with the leverage quartiles, as well as this treated by post execute. And I also test whether borrowing constraints hold for experienced borrowers. So I define experienced borrowers as accounts with an account age greater than the median age. So the first two columns, you can see when platforms are still discussing the proposal, borrowers with the highest leverage is insignificantly different from borrowers with the lowest leverage. So here I use the borrowers in quartile 1 as a benchmark. And after platforms officially execute the collateral requirements, the borrowers with the highest leverage would increase borrowing by 16% and raise leverage ratio by 1.016 relative to borrowers with the lowest leverage. The borrowing constraints also hold for experienced borrowers. For experienced borrowers, when platforms are still discussing the proposal, there is no significant difference between borrowers with the highest leverage and borrowers with the lowest leverage. And the borrowers with the highest leverage significantly increase loan balances and raise leverage further compared to borrowers with the low leverage. Okay, so for other tests, I implement several robustness tests. I show there's no significant differences in behavior between experienced and inexperienced borrowers. I show the borrowing constraints also hold for non-smart contract users. So for DeFi lending platforms, users can interact the platforms using smart contracts. Those users are sophisticated users. I look at several address. Some of the address they are the liquidators in this platform. They are not the borrowers in this platform. And I show the borrowing constraints hold for the group of users not using the smart contracts. I also cluster standard errors by different level, and I show the results are similar. I implement one of the placebo tests. The collateral requirements, they should only affect users with borrowing positions. Users without borrowing positions, they supply cryptocurrencies on the platform to earn interest, and they are not. They should not respond to the relaxation events because because the collateral requirements does not affect them. So I show that users without loan positions, they would not respond to the relaxation events. So at the end of the test, the paper, I show such increased borrowing activity after the relaxation events leads to higher interest rates on those borrowing platforms. To wrap up, the DeFi aims to provide improve financial inclusion, equality, and democratization. And DeFi current design borrowers, they face the same collateral requirements. They pay the same borrowing cost, and these platforms, they can be accessible from anywhere. Anyone with an internet connection can participate on the platform. However, the current design requires loans to be over-collateralized. The majority of the accepted collateral is in the form of cryptocurrencies, but the prices of cryptocurrencies are highly volatile. So this paper aims to quantify the borrowing constraints on those lending platform. I utilize events where platforms relax those collateral requirements, and I show that borrowers they increase borrowing and raise leverage further after platforms relax collateral requirements, which suggests that before the relaxation, they are constrained by the collateral requirements. And I show that collateral requirements disproportionately affect highly leveraged borrowers, and such kind of borrowing constraints hold for borrowers irrespective of their DeFi lending experience. So overall, this paper, the results in this paper suggest that the borrowers, they without sufficient collateral, they either face financial constraints or they could be excluded in this market. Thank you so much for all of the questions and suggestions, and they are very super helpful. I definitely want to explore further. Yes, thank you so much. I'm happy to answer any other questions you might have.